2024 was a great year for the stock market and shareholders in general. But instead of the usual Santa Claus rally, in December, Krampus decided to crash the party and the market. So, with the stock market having receded from its all-time highs and proposed tariffs alongside cuts to immigration apparently on the way, could there be more disappointment to come in 2025? Well, I'll be going through that as well as how my portfolio performed throughout fiscal 2024 in this video. My name is Paul and I've been investing $100 per month on this YouTube channel for 3 full years now. My goal with this real money experiment is to document the investing journey of a hypothetical Canadian who will never be able to max out their tax-free savings account. My hypothesis is that people who only have a little bit to set aside at the end of the month can still achieve financial freedom by following a disciplined plan of investing what they can on a consistent basis. So definitely stick around to see how the journey's been going so far. Anyway, before the stock market pullback that occurred over the holidays, shares were trading at all-time highs with an average price to earnings multiple nearing those seen towards the peak of the dot-com bubble. But things have since come back down a little bit and we're now sitting just shy of 30. Which is still very high. So I think that despite this recent dip, there's still definitely a lot more room for the market to tumble if we expect to get back down to the historical average PE ratio of about 18 to 20. But I've already talked in depth about the market's dangerously high PE ratios. The gist of what I want to get at here is that we're already pretty precariously positioned going into 2025. Equally importantly is that there appears to be some fast approaching propositions that could tip us over the edge and lead to a significant correction. First off, we have the proposed 25% tariffs that the US is considering imposing on Canada. According to the Canadian Chamber of Commerce, this is likely to impact Canadians to the tune of $78 billion. Or, on a more personal basis, the average Canadian would be impacted by about $1,900 per year. This makes up more than the entirety of my hypothetical Canadian's annual investment capital that I track on this channel. So this will be a stark and brutal shift if the data analysis is correct. According to the Bank of Canada, economists estimate that incomes in Canada are between 15 and 40% higher thanks to freer trade. To better highlight the bipartisan disdain for the effect of tariffs, here is a Republican-authored article written in 2018 and published by the George W. Bush Institute with the title that makes it incredibly clear that tariffs harm more people than they benefit. This is because a tariff is designed to make certain products more expensive, usually for the purpose of making labor in that country issuing the tariff more competitive in its national economy. This is great for workers who are nationally producing similar goods or services to those that are being tariffed and coming in from abroad. So, the national companies can charge more money for their products and give more money to their workers while still being competitive with imported goods. Unfortunately, tariffs are bad for almost everyone else because when you go to the store, the price of those tariffed goods or services are going to be higher by approximately the exact same amount that was tariffed. And this is the beginning of a vicious cycle, because when prices go up, people buy less, and when people buy less, businesses produce less in response. Less required production leads to less required jobs, which leads to layoffs, increased unemployment, and an overall worse economy. This is why tariffs are often considered to be a lose-lose economic policy. And that's before we assume any retaliatory tariffs are implemented on the other side. So, obviously, if these proposed tariffs are implemented, there will be negative impacts that will affect consumption and production, and it will inevitably impact company earnings in a negative way. But that's not the only headwind that we're facing. Canada is going to be implementing sharp cuts to its immigration targets, which is expected to get rid of just shy of 900,000 temporary residents, while also reducing the incoming number of permanent residents to 775,000, for net migration of about negative 125,000 between 2025 and 2027. And while this should help to alleviate some pressures on the housing and job markets, it will also have a negative impact on GDP and inflation, since with less workers, there'll be less demand for jobs, pushing up wages, which will in turn push up prices. And as you already know, higher prices means less buying, less work, and less profit. So any company guidance that was counting on a continued supply of cheap labor and more sales will likely end up paying more in labor while receiving less in revenue. And while we in Canada like to think of ourselves as a separate entity from the United States, unfortunately in this instance we are economically joined at the hip. And one of the proposed policies of the new administration is to run the largest deportation plan in American history. There's an estimated 11 million undocumented or illegal immigrants living in the United States, which is almost 3% of the population. And while it certainly is not a good thing to have people illegally living in your country, many of these people do participate in the economy, working jobs and purchasing goods and services. And again, less workers means higher prices, less buying, less work, and less profit. So, when we in Canada export our goods and services to the United States, if there's less money sloshing around in their market, there will be less sales, less demand, and ultimately less profit for us, which could act as a serious contraction to our jobs and impact how much money we have to spend at home. The reality is that we are America's top trading partner, and according to Statistics Canada, over 80% of our exports go to the United States. To put that into perspective, over 25% of Canada's GDP comes from trade with America. So, simply put, if their economy performs poorly, it will impact us heavily. Now, while Canada's reduction in immigration over the last 2 years does appear to be set in stone, neither the tariffs nor the deportations in the US are guaranteed. While both these policies were major talking points during Donald Trump's campaign, Trump has reversed course on some policies that have grown unfavorable in the past. And considering that the blanket implementation of tariffs and mass deportations would have incredibly negative effects on the consumer, there is still some hope that he'll listen to reason and soften up when it comes time for him to take office. Regardless, right now the market is in a place of uncertainty, and a lot of upside is already baked in. Add on top of that the upcoming economic headwinds, and to me, it looks like a recipe for a crash. That said, I'm hardly qualified in economics or politics to give you anything outside of my best guess as to what's coming over the next year. There are tons of other economic factors that could offset potential tariffs or reductions in population, and I know Trump's true political intentions about as well as I know the upcoming Powerball numbers. It's certainly at the very least possible that he's using the threat of tariffs to strong-arm Canada into agreeing to some other set of terms that will benefit the United States. How likely this is kind of up in the air, but from my perspective, there's a lot of risk and not a lot of upside left in this market. So this definitely isn't going to be the year that I'd want to be betting on the S&P making another run-up of 20+%. Fortunately, there are patches within the market that still appear to be undervalued. One such company that I've been investing in is MTY Food Group, which has not only completely missed out on the market's gains for 2024, but has actually declined in price by a whopping 16%. MTY is a company that operates in the restaurant industry and is responsible for franchising out 90 different brands, including Cold Stone Creamery, Wetzel's Pretzels, Papa Murphy's, Famous Dave's, Sweet Frog, Thai Express, and many, many more. Looking at this price collapse relative to the market's gains, you might assume that this year was an absolute disaster for the company. And there certainly have been challenges, including the extreme weather event causing power outages and temporarily driving down demand for dine-in restaurants, the ending of pandemic-related SNAP benefits in the United States, the ongoing issue of net store closures, and stagnating revenues. But when it comes to the bottom line, MTY has been growing immensely, with free cash flows up 26.6% on a trailing 12-month basis. And this capital has been funneled back into paying the debt accumulated from the company's major acquisitions of Barbecue Holdings and Wetzel's Pretzels in 2022. And thanks to the growing free cash flows, the company will be able to allocate more money towards chipping away at that debt pile, which will lead to lower interest expenses and more money that can be used for buying back shares and raising that dividend, which they just bumped earlier in 2024 from 25 cents per quarter to 28 cents. Meanwhile, the payout ratio is still well below 30%, and on a recent conference call, the company announced that they've successfully negotiated to eliminate the maximum allowance of capital that can be returned to shareholders, which was previously in place to ensure more favorable interest rates on the debt. So, the company will almost certainly be looking to further increase the dividend, most likely in the coming quarter. And they'll probably also be buying back more shares. That said, MTY was not sheltered from December's wrath, since the stock did fall about 4.5% over the course of the month. Plus, I think the company would be, at worst, moderately impacted by the headwinds discussed earlier, most directly by the reduction of international students who temporarily fill employment gaps in the fast food and casual dining restaurants. Without them, there is likely going to be a struggle to maintain optimum levels of employment, which will lead to slightly increased labor costs and food prices, which will in turn slightly lower demand. There would also probably be a mild impact from the proposed tariffs if they do end up going into effect. But usually, fast food and casual dining restaurants like MTY's surprisingly perform well in many scenarios where consumers have less disposable income. It's usually the mid-priced mom and pop restaurants that suffer the most, since your dollar doesn't stretch as far there. But people love eating out, and even in recessions, the drive-through lines are full. However, in longer-lasting periods of depression, even the low-cost restaurants do tend to suffer. So I would consider MTY to be at a mild to moderate economic risk. And while the margins might shrink a little over the next year or so, I think the company still offers a great long-term value at a trailing 12-month price to free cash flow of only 6. The next company that I've been investing in is GoEasy, a company whose mission statement is to ethically lend money to non-prime borrowers with plans that are flexible and easy to understand. And this is another company whose price performance was worse than the broader market in 2024, only going up by 7.4%. Unlike MTY, however, GoEasy's performance has been phenomenal across the board. The trailing 12 months earnings per share was up over 38%. The loan book was up 28%, and there was record growth in customers and continued expansion of the network and the company's margins. GoEasy also beat on earnings expectations every single quarter this year, and they announced that they were in the process of rolling out new credit card products that should allow the company to reach even more customers. So, what went wrong in the year? Well, GoEasy is facing an upcoming regulatory change that will lower the maximum allowable APR on loans from 47% down to 35%. But this change has been in the works for well over a year now, and the company has been actively adjusting its lending practices to better align itself with Canada's new regulation. And while this will reduce the amount of loans that GoEasy can write in a year, the expansion elsewhere should more than make up for those losses. Plus, GoEasy's average APR on its loans is already well below the 35% maximum, so this change isn't likely going to have a massive impact on the company. Instead, the biggest driver of share price throughout the year was probably the announcement that the CEO, Jason Mullins, will be stepping down effective the start of 2025 to join a position as a CEO of a private company that's located in the United States. Since this announcement, GoEasy has continued looking for suitable replacements, but so far, no one has been found. Instead, former CEO and current board member David Ingram will be stepping in to temporarily fulfill the role. Mullins was definitely a huge asset to the company, and his decision to leave will be felt. But in his own right, David Ingram has been an exemplary steward of the company, during his tenure and in guiding Mullins as his former replacement. So the company's definitely in good hands. It's just a matter of uncertainty. Who is going to fill in this role of permanent CEO, and how will their methods differ? Personally, I think that GoEasy is an excellent company, and if it sticks to its pillars, the business will continue to outperform, and the market growth will be undeniable. In this upcoming quarter, the company is expected to share its updated guidance with investors, and as per usual, I would be surprised if there wasn't some new positive revisions, as there always seems to be. So, assuming things go reasonably well, I think that we could see a return back to strength in 2025 once the company officially announces its new leader. Now, GoEasy did dip by about 1.2% in December, and unfortunately, I do think that this company is at greater risk of being negatively impacted by potential tariffs and recession in general, since the company is still in the stage of taking on debt in order to grow optimally. Because the company's business model involves lending out money to people with bad credit, the worry is that there is a greater likelihood that people within this group will be at a greater risk of losing their ability to pay back their loans should hard times hit. This could leave GoEasy in a pretty uncomfortable position, or worse, if there's any extended period of hardship. And if there's excess charge-offs, the company may find itself in trouble. Noting that, GoEasy has been doing a good job of extending maturity dates on its notes out relatively far into the future, which will hopefully provide either enough time to survive a moderately long recession, or expand to the point where the cash coming in from the loans is able to fully fund expansion without requiring further usage of debt. Ultimately, I think that I would classify GoEasy as being at a moderate to high risk of impact, mostly stemming from the downstream effects of tariffs. And this risk is why the company is positioned as such a small portion of my total portfolio. Now, because this company is still in its growth stage, I definitely would prefer if it did not pay a dividend and instead funneled that money back into the growth of the loan book. But I think that regardless of this decision and the risks pertaining to the debt levels and its business model, GoEasy is offering a great reward for the risk at only slightly over 10 times earnings. Last up, I've been buying shares of the Morguard North American Residential REIT, which is a real estate investment trust that rents out apartment units in buildings to tenants in Canada and the United States. And this one has actually had a pretty decent 2024, making an upwards move of 17.6% while also paying out a considerable monthly dividend. And that was despite a pretty steep drop in December. But unlike my other holdings, on the business side, Morguard had a pretty sleepy year with no major disruptions, acquisitions, or any of the like. The only things that we saw happen were consistent rent growth in both Canada and the US, as well as rising property values and share repurchases. One of the ways that I like to calculate the true value of a REIT like Morguard's is by looking at its tangible book value per share, which calculates the net asset value of the trust's properties. In Morguard's case, this has increased from 49.1 to 51.6 over the course of the year. But the share price has also increased since then, going from $14.40 to about $17.44. So while the underlying value of the REIT has increased, some of the potential upside has already been achieved. Thankfully, there is still quite a ways to go, with the company only trading at about 1/3 of its tangible book value. Additionally, the REIT will be refinancing a portion of its properties over the coming year, which should free up some additional capital. And the REIT is considering a substantial course issuer bid, which is an offering to buy back a substantial portion of the shares outstanding directly from investors, as opposed to just repurchasing shares for cancellation on the open market. With each share repurchased, remaining investors gain ownership of the discrepancy between the share price and the tangible book value. Plus, with less shares on the market, there will be added upwards pressure on share price. Now, it's important to be aware that this is a consistently profitable REIT, So it doesn't make sense for it to be trading this far below its net asset value. And over the long run, I would expect that this discount will dissipate. That said, the latter half of December was really rough on MRG, and shares came down roughly 6% over the course of the month. And that's somewhat surprising since Morguard is probably the best defensively situated holding within my portfolio. Don't get me wrong, rent prices could be impacted by the effects of tariffs on the economy. But the REIT is highly profitable, and in recessionary scenarios, contrary to popular thought, rents actually tend to rise since there's more foreclosures on mortgage payments and less capital available for purchasing homes, increasing the population of people who are looking to rent. And when supply is stable and demand increases, so does rent and occupancy. Now, in the case of reduced immigration, this could have an effect, especially when combined with the building of new homes. But currently, Canada is way behind on its home building relative to the current population growth, even with the Liberal plans to construct 100,000 new homes and 131,000 new apartments by 2032. There's just way too much demand for housing in cities where Morguard owns its buildings. Plus, the rent control policies established by the Conservatives in Ontario ensures that there will be continued rent increases for years to come. While on the US side, only a few of the REIT's properties are in locations that would be impacted by the busting of illegal immigration, and the effect would likely end up being only mildly negative to fairly negligible. Plus, the REIT has plenty of liquidity and capitalization available at their fingertips to withstand almost any recessionary scenario. So, I would consider Morguard to be at only a mild risk of being economically impacted by the potential headwinds. This, along with the potential upside, is why the Morguard North American Residential REIT makes up such a large portion of the monthly portfolio. Unfortunately, over the 1 month period, my portfolio did perform poorly. But on the year and since inception, things have been going pretty well. In total, we're up about 3% or $113 on the $3,790 that has been invested in. But that also includes about $190 worth of reinvested dividends. So in actuality, the portfolio is up closer to $303 on the money that I've personally put into the investment account on Wealthsimple. To get an idea of just how bad December was for stocks, at this time last month, my portfolio, represented by the green line, was sitting on about $530 in gains, meaning that this December dip crushed over 40% of those gains. But throughout the year, the portfolio did quite well. At the end of 2023, we were actually sitting on a loss of $78. So, finishing up 2024 with an unrealized gain of over $300 is by no means a terrible outcome. Sadly, in comparison to the ETF benchmarks, our performance has been underwhelming over the last 2 years. Though in recent months the gap has been closing somewhat, with an obvious exception needing to be carved out for the S&P 500, which continues to roar forwards and was even by far the best performer of the group in December. In a shocking turn of events, the perennial second place contender in the Global Value ETF, shown in pink, ended the year below the two Canadian market ETFs, despite having a sizable gap on them throughout the better part of 2023 and 2024. As for the red line with the stars, that indicates where I would need to be in order to achieve my goal of attaining a 12% annualized rate of return. So, of course, December was a step in the wrong direction. Last month, we were less than 2.5% away from surpassing the goal, but now that goal is a much more challenging 9.4% away. But while this backstep is far from ideal, last year at this time the portfolio was over 15.5% away, and when the gap was at its peak, we needed over 27% to catch the goal. So, everything considered, I'm fairly optimistic that we can catch back up and even get ahead. In order to do that, I'm going to need to invest this month's capital plus the dividends that were earned in December. And so on Friday the 3rd, I purchased 4 shares of the Morguard North American Residential REIT for $17.49 each. In addition to that, I purchased 0.4301 shares of MTY Food Group at a cost basis of $46.19 per whole share. And finally, I picked up 0.1189 shares of GoEasy at a cost basis of $168.13 per share, leaving my portfolio with 1 cent left over after my orders had been filled. So, as of the market's close on Friday, January the 3rd, the portfolio has 163 shares of the Morguard North American Residential REIT worth roughly $2,860, about 17.3 shares of MTY Food Group worth just over $798, and 2.19 shares of GoEasy, which are now worth approximately $368. Heading over to the dividend tracking chart, in December, all of the dividend income came in from the Morguard North American Residential REIT, which paid out $9.82. And that locked in 2024's total dividends earned at $119.80, just $10.20 shy of the goal that was set at the start of the year. But for the hypothetical Canadian that this experiment is based around, that's more than a week's worth of groceries, or more than a month's worth of phone service, or several months of gym membership. And while we're still quite a ways off from paying the rent, let alone financial freedom, we're only going up from here. So I'm setting the 2025 dividend goal at $210 because I think that with the reinvested dividends compounding, we should easily vault the $200 mark. And assuming I continue holding MRG shares and they don't cut their distribution, we've already crossed the last time that the portfolio will ever earn less than $10 per month in dividends. Additionally, we have another 2 dividend growth stocks that will be announcing raises in the coming months. And this month, we've surpassed $200 in cumulative earned dividends since the portfolio's inception. So there's a lot of momentum going for us into 2025, and I'm excited to keep counting the dollars as they roll in. So 3 full years of investing $100 per month, and we're now guaranteed $10 per month for life, and we've already earned back over $200 in dividends. That's pretty sweet on its own. But taking a look at the yield on cost, we can already expect to earn over $153 per year in dividends, assuming no changes are made to the portfolio or the dividend payouts. That's more than a 55% increase from where we were coming into 2024. And the dividend yield on the money that I've personally contributed to the portfolio is up a full 20 basis points on the year, now hitting a solid 4.15%. So, all in all, I would say that 2024 has been a successful year for the portfolio, even if we didn't hit all our goals or outperform the benchmarks. In the overall lifespan of investing, we're barely past the point of crawling. There's plenty of time to catch up, and untold obstacles and challenges waiting to be overcome. So bring on 2025, I'm ready for it. And with that, I'd like to thank you all for watching, and I apologize for any delays in getting out this month's video. I'm overcoming a cold, but thankfully, unlike last year, there were no vehicle malfunctions. There was just a lot of traveling back and forth to see family and friends, and then traveling back home. But for anyone interested, here's the planned schedule on screen for the monthly series episodes in 2025. Anyway, that's about all that I have for this 37th episode of the series, but before you go, please remember that this video is not financial advice and that I am not a financial advisor. This video was made entirely for the purpose of providing inspiration and insight into my personal investment decisions, and it should not be used as a substitute for doing your own research. This video does not have the information required to make good investment decisions on individual securities, so again, I'm not a financial advisor, I'm just a Canadian who likes to invest and share my opinions with others. And in doing so, I hope that I was able to provide you with something of value. And if I did, then please consider sharing it with anyone else who may also benefit from it. Thank you for watching all the way to the end, and enjoy the rest of your day.